A true example of downside risk management when it comes to your investment portfolio. Not some crappy stuff on asset allocation or market timing. I'm going to share with you right now a true example, a true illustration of how active management can be used to mitigate downside risk. And so let's talk right into it. So don't forget to subscribe down below. You're at the Heritage Wealth Planning YouTube channel, the place you come to hopefully just get some insight on other aspects of financial planning. And now we're going to talk a little bit about investing, which you know is near and dear to my heart, but I do have some issues with it. So don't forget to subscribe and comment. All right. So first and foremost, I was about 2 years ago or so, I was introduced to a group called Swan Global Investments. Swan Global Investments. They have something called a Swan Defined Risk Portfolio or something like that. And a Swan, and I think is Randy Swan out of Alabama or Phoenix. We'll look him up. I can't remember. I never heard of these guys. It didn't mean anything to me until I started looking a little bit deeper. This is not a recommendation. Don't buy this. Don't invest in it. Don't do anything I say. My goodness, I'm not recommending it to you. What I am showing you, though, is when you are actively trying to mitigate downside risk, it can pay dividends as long as you're doing it right. My pet peeve of mine is that these active managers or investment guys, and this isn't even people who say I'm day-to-day trading, but these are people saying, oh, we're going to protect against the downside because we have a diversified portfolio. No. Everything reverts. When risk happens, everything goes in one direction. All right. I mean, I'm just telling you, in 2008 was a perfect example of that. So you have these portfolios that say, oh, when the stocks are up, bonds are down. All right. Or when international's up, equity US is down. They say, look, all these things are correlated. So there's a low correlation. That way, when oil is up, gold's down or something like that. Well, in 2008, everything was positively correlated, about 90%. All right. There's a 90% correlation between everything except for government bonds. So just always remember that. And we're not even talking about government bonds with Swan here. We're going to tell you about something else. So when the people say I'm diversified because we have a negative correlation between this, that, and the other, and gold is not correlated with stocks and blah, blah, blah. In 2008, my friends, everything was correlated except for government bonds. Everything, real estate, you name it, doesn't matter. And so if you were banking on downside risk protection because you had a diversified portfolio of 7, 8, 9, 10 different asset classes, you still got hammered. Just no getting around. The only thing that didn't get hammered was cash and government bonds. All right, so now you got these guys say, well, I don't actively manage your portfolio. I'm not picking stocks, but I'm actively managing the allocation of your portfolio to keep you from losing money in the downside. And then he said there in 2008, well, what happened? Well, we didn't realize that everything was going to be positive correlated because our metrics, our numbers, our models, remember, and I got my book over here, which is my growing list of books I need to read. Models behaving badly. Our models said everything was, we had low correlation, and yeah, that model broke. All right, and so, but now they're still going to charge 1%. That ticks me off. It ticks me off that these guys are insinuating they can protect you from downside risk, basically due to asset allocation. There's just no validity to that. There's no proof of that whatsoever, and yet you're going to pay 1% for that. Now, there are ways active management can do it. And that's what we're going to talk about. Swan Global Investments and their defined risk is DRC, I thought. Divine risk something, DR's divine risk portfolio. And I'm going to show with you of how if you want to pay for active management, you need to pay for actively being hedged. And there's a thing that goes along with being actively hedged, which means you are leaving money on the table, big money potentially, when the markets are up to avoid the downside. That's it. If you're going to take the risk of the market, you should expect to get the risk of the market returns. All right. Risk, return. If you're going to reduce the risk of the market, you should expect to get lower than market returns. There's just no two ways around that. This idea that we can get market-like returns without market-like risk is just, oh, please stop. There's no proof of that. If you're going to take the risk of the market, you're going to get market-like returns. If you're going to reduce the risk of the market, you're going to get reduced returns. There's just no two ways around that. So hedging simply means we're putting money at stake in order to protect us on the downside. If the downside doesn't come, we lose money. So let's dive right into this. And again, this is Swan Global Investments. And tell you what, let's hit about, before we do that, we'll start with the numbers. Defined risk strategies, DRS, that's what it's called. by Randy Swan. I think he's out of Alabama. I've never met the guy. I don't know. I mean, I've never talked to him, never met him. I love this portfolio for what it does. I don't have it, and I'm not saying, again, you shouldn't. No. Don't listen to anything I say in terms of what you should buy. By actively seeking to not lose big, we believe that investors will be better off in the long run. I'm telling you, there's some huge validity to that. If we can avoid the sharp losses on the downside, we can be better off in the long run. I don't necessarily subscribe to that theory, but I makes sense. Absolutely. If we can avoid you getting crushed, i.e. 2008, we will avoid you getting the glory of 2009. But in the long run, we should be better off because you didn't start from such a threshold of down. So just remember, get $100,000 in your portfolio. It drops 50%. You got $50,000 in your portfolio. What happens to get back to 100%? You need a 100% return. So 100,000 drops 50. You need to go up 100%. All right. So that's how the losses work mathematically wise. Losses are lower and the gains got to be higher just to break even. So Randy Swan is saying if we can eliminate that 100 to 50, we don't need to get that 100% on the upside. We don't, because we've eliminated that quite a bit. So Randy would say if we can get a 10% loss as opposed to a 50% loss, we only need to get an 11% upside in order to break even. So think about it like that. $100,000 loses 50%. We're down to $50,000. I need a 100% return just to get back to $100,000. $100,000 loses 10%. It's down to $90,000. I need 11% return just to get back to 100. I hope that makes sense because it's fundamental on limiting your losses, which leads me to another one. Ride your winners, cut your losses. But we'll talk about that for other videos. All right, so here's our legacy of success. We put our defined risk strategy to the test in July 1997. Since then, our innovative approach has provided the opportunity for growth while reducing our downside exposure, helping our strategy consistently outperform both the S&P 500 and the traditional 60-40 portfolio over full market cycles. All right. And so what they're saying is here, net, and I'm not sure if this is net of fees. I think it is, but I don't think it's net of the fees that your broker's charging you. I think it's just net of the Randy Swan fees. But if you're paying another 1%, it won't be the same. And there's another thing, too, we got to look at, too, when it comes to IRAs versus taxable accounts. So we'll talk about that here in just a second. All right. So here's a Swan defined risk going to July of 2018. And you can go on this website, just swanglobalinvestments.com. July 1997, you put $100,000 in there. And at the end of July 2018, basically 20 years, it's worth $556,000. All right, if you would have put it in the S&P 500, that $100,000 is worth $490,000. And if you would have put it in a 60-40 stock bond portfolio, that's worth $415,000. So Swan shown, is that or shined? I guess it's Swan shined, I guess, or shown. I don't know. I guess shown. Anyway, so what happens is since inception, Swan has averaged 8.41% a year. S&P 500 has averaged 7.77%. And the 60-40 is average 6.93. All right, now year to date, and this is where the drawback of the Swan portfolio is. I've been there. S&P 500 is up 10.56, and this is as of September 30th, by the way. And I bet it look a lot better now that we've had a 10% decline in S&P 500. Swan is down was up 1.75. So we're just going to compare the S&P 500 for the time being. Over 3 years, Swan has got roughly 8, and the S&P 500 has got 17.5 roughly. So Swan has even a bit within spitting distance of the S&P over the last 3 years. Same thing with 5 years. Swan's up less than about 40% of the S&P 500. So essentially what's happening here is you're getting roughly 40% of the upside with a whole lot less risk. That's all there is to it. Now, compounded over time, in theory, that would mean you'd make more money because even though you're only getting 40% of the upside, when you're reducing the risk, you're not having these big declines right there. So essentially, you're saying at the end of the day, because I've reduced that risk on the downside over the course of a market cycle, in this case, 20 years, I've actually outperformed. So I'm up 8.41, where the S&P 500 is up 7.77. Very attractive argument to make. And I completely subscribe to that. If you can reduce the losses on the downside, you have less upside you need to pull ahead. You just do. Again, if you have a 10% loss, you need 11% to break even. If you have a 50% loss, you need 100% to break even. And so Swan shows us that right there. So growth of $100,000. And again, this is net of Randy's fees. I don't think it's net of if you're paying another guy. Let's just put it this way. I worked for a firm that Randy would charge something like 1, and the other firm would charge on top that 1.2. And that's just, that's going to be tough. But either way, I mean, that's what you have to contend with. All right, so let's keep going down. Minimizing losses during bear markets by we win by not losing, by actively seeking not to lose big. And that's why I love this right here. All right, look at this chart. I love it. I mean, this is just fantastic. All right, so I love it because what's happening is here's the S&P 500 right there in 2008. S&P 500 was down 37%, my friends. 60-40 portfolio was down 22. Randy Swan and crew were down 4.5. All right, here's 2000, 2001 and 2, and you should know this by now. In 2000, the S&P was down 9. In 2001, the S&P 500 was down 11. In 2002, the S&P 500 was down 22%. So we got Randy was up 3.17 in 2000 when the S&P 500 was down 9. Randy was up 7.46 in 2001 when the S&P 500 was down 12. And Randy and crew were up 12.22% in 2002 when the S&P 500 was down 22%. And the reason that's hedging. That's how it works. So as options, so they're buying options, selling puts, do the whole thing. They're saying when the market goes down, our defensive strategy will be worth more when the market goes down. When the market goes up, our defensive strategy will not be worth more. We'll have wasted money essentially buying options to protect the downside. But when the market goes down, we make money. That's what happens. When the market goes down, we make money. Here's 2015. Randy and crew were down 3, where the S&P 500 squeaked out a 1.38% return. And so, again, now if you go back, look at this. In 2010, Randy was up 8. S&P 500 was up 15. 2011, Randy was down 5. That was in 2011. I just remember July 15th to August 30th or something like that. The markets got crushed. Nothing else jumps out at me specifically. But anyway, at the end of the day, Randy's crew was down 5%, where the S&P 500 squeaked out a 2% gain. And you can see the blue, here's 2013. The S&P 500 is up 32. Randy and crew were up 14. I mean, that's what happens. When the markets go down, the Randy goes up. When the markets go up, Randy and his crew don't perform as well. There's just no getting around that, my friends. All right, so up and down here, this is what I love too, the upside downside capture. So let's see here, 1997 to September 2018. There you go. So the S&P has 100% of the downside, of the 100% of the upside, I should say. Randy and crew have 42%. I mean, that's exactly it. So the market goes up 100, you're going up 42%. Capture on a quarterly, that's on an annual basis, or is that just the entirety? Yearly, they're capturing on any given year, they're capturing 56% of the up of the market. Over the course of the 20-year experience, they're capturing 42%. So essentially, literally, I don't care about the year over year. You're going to get roughly 40% to 50% of the market upside. We'll just say 40%.